Fourth quarter 2024 results from corporate America have been pouring in, and investors have been keeping a lookout for any warning signs that may have surfaced. Now, one thing that got flagged is that published data showing there exists a significant difference between the seven largest companies in the S&P 500 and all the rest. And our research director, Shiraz Mian, is here to help us try to understand that. Shiraz, I'm understanding that that's because the larger companies have boosted their spending while the others haven't. I think you even wrote about that in one of your written commentaries. Is that going to be an issue going forward?
Yes, Terry. The Mag 7, the Magnificent Seven companies that you're referencing here, the issue with them from the market standpoint specifically is their very heavy spending on artificial intelligence related infrastructure. And this has been an ongoing issue the last few quarters as well. And these are the magnitude of the spending are so huge. And the timeline for any payoff from these capital budgets is so hazy and uncertain that has investors a bit on edge. And when China's DeepSeek AI model came out, which at least per reported numbers was executed with a lot less money, that added the pressure on these companies. So we'll see how all of this shapes up. But you're absolutely right. These companies are spending a ton of money. And as of now, they're sticking to their plans, and they feel it's essential for them to stay competitive and to maintain their leadership in technology in the coming artificial intelligence world. And that is a source of concern for the market.
So Alphabet fell short on its cloud segment revenue. Advanced Micro Devices quarterly numbers failed to impress the market. Their data center sales failed to meet expectations. And Amazon issued a disappointing revenue forecast, but despite all that, that didn't hold the rest of the Mag 7 back, did it?
No, it did not. Overall profitability for the group remains rock solid. They are still, despite their enormous sizes, growing at very impressive rates. So for the group as a whole, earnings are up almost 30%, Q4 earnings. But you're right in flagging the cloud issue. That appeared to be a recurring theme. So Alphabet and Amazon and Microsoft, all of them gave out numbers that were less than solid. But as you know, these companies have so many different businesses, and even when the cloud business was relatively softer, it was by their own lofty standards. Still growing. Just in Q4, it did not grow as impressively as many in the market expected. But on the whole, the growth outlook for these companies and the overall earnings power of these companies remains unmatched.
Is that also true for the tech stocks as a group aside from the Mag 7?
Yes, it is. Tech has been for some time now, ever since we came out of COVID, and then we had a year and a half or so, about 6 quarters of kind of adjustment period, tech has been in the forefront of aggregate growth. So in fact, over the last year and a half, 2 years, tech has been the lone kind of shining area that's been carrying the aggregate growth picture, and that still remains the case, even though the expectation is that this year and beyond, we'll see a number of other sectors also join the party, and tech will not be just the sole driver for the market as a whole.
Okay, let's recap the scorecard.
So, including all of this morning's results, Terry, we now have S&P 500 results from 370 of its members, almost 74%, exactly 74%, in fact. 12.1% is the earnings growth for this group of 370 index members. 5.6% revenue growth. 77.8% are beating EPS estimates, and 64.6% are beating revenue estimates. And if you put this growth pace in the context of what we had seen from these companies in recent quarters, you will note a pretty clear acceleration in the growth momentum. So earnings are growing better than what we had been seeing in recent quarters. Same on the revenue side. The beat percentages are a bit on the lighter side relative to historical levels, but even the beats percentages are better than what we have seen over the last couple of quarters.
What about margins?
So margins are holding up pretty nicely. In the aggregate, for the S&P 500, Q4 margins will be up about 87 basis points, just a little shy of 1 percentage point. A big chunk of that is coming from technology and finance. Energy still remains a drag, as are some of the other economically sensitive parts of the economy. But on the whole, companies seem to be doing a pretty good job with maintaining their margins.
And what about, aside from what we've talked about already with the Mag 7 and the tech stocks, any other standout sector issues that you see?
So as I noted, finance has been very good. We saw that at the top of the reporting cycle. Very impressive results there. The economically sensitive areas, the materials, the industrials, not so impressive in terms of the growth pace, but even there, the management commentary, for the most part, has been fairly reassuring and positive. So nothing materially and notably negative that one could put one's finger on as a particular area of concern.
So we can infer then that you don't see any corporate warning flags this season?
Not on the whole, Terry. The tone and substance of commentary in the aggregate has been fairly reassuring and positive. There are some risks that these management teams would point to. There are the usual things about some inflation issues, uncertainty about the trade issues that the Trump administration has with a number of trading partners. But as far as the underlying demand trends for their own industries, the commentary from management teams is on the whole fairly positive.
Investors seem to have been on a stock buying spree lately. Do you think they're focusing too much on company fundamentals like earnings and missing the bigger picture?
Earnings are important, Terry. In fact, what history tells us is that in the long run, there are two primary drivers for stock prices. It's earnings and it's interest rates. And having checked this box, this earnings season, the earnings box, that is, that there's nothing material to worry about. The issue then comes to interest rates. And even on that front, we are in an easing cycle, and these are both fundamental issues. And I think that's the right thing for investors to be focused on and to be confident that we're heading in the right direction.
The retailers are going to be reporting last. What do you see in store for that group?
So on the whole, the earnings outlook for retail is a function of the financial health of households, which on the whole, as we have discussed in the past as well, is fairly stable. Obviously, at the bottom end of the income distribution, there has been stress for a while. But as you know, the labor market remains strong. The picture on the wages front remains strong. So on the whole, the trend on the sales and revenue front for these companies should be good. I suspect we will hear relatively more about the impact of the coming tariffs on business outlook for these companies, which will, to the extent that the tariffs don't get passed on to consumers, could be a problem for margins, particularly for the likes of Walmart, Target, and some of these other players. But I think on the whole, the picture remains fairly good, even for retailers.
So what's the bottom line growth rate for Q4 as far as you can tell right now?
As of now, it's tracking to be 13.1%. If you strip out the drag from the energy sector, it's close to 16%. I would think that when all is said and done, we'll perhaps be closer to this ex-energy level, meaning close to around 15% earnings growth, which will be very good. This will be the best earnings growth we have seen in quite some time. So Q4 is shaping up to be a pretty solid report card on the corporate profitability front.
All right, we want to remind our listeners that they can always check out your written commentary on the homepage of Zacks.com. Mondays, the earnings preview goes up, and on Thursdays, there is an updated version of the earnings outlook in written form. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.